afternoon, everyone. I'm Pamela Hastings, and we welcome you so warmly to another Barometer Readings webcast. Joining me today, as always, is our Chief Investment Officer, David Burrows, who will be pleased to provide a global macro overview. And of course, at the tail end of the conversation, be happy to address your questions. You can send those questions via the Q&A or the chat on Zoom. And on this beautiful June 18th, afternoon, I turn the conversation over to the one and only David Burrows. Good afternoon, David.
Hi, Pamela. How are you?
Wonderful. Great to see you as always.
Good to see you too. And thanks everybody for joining us today. We've now been about 6 weeks, maybe 8 weeks of some narrowing breadth in the market, which means that participation or the number of stocks performing well has been narrowing. And of course, the $64,000 question is, what does it mean? What can we take away from it? We're going to just jump into sort of some market internals and take a look at the various asset classes that we're focused on, some of the sector themes to see what, if anything, is changing. In many ways, the market has been selective now for almost 2 years, with a small number of stocks providing a lot of the returns, and it's been really important to be focused in some of the leadership areas. But this is something that we always spend time on, trying to understand what's changing, what needs to change in the portfolios. Should we be putting new money to work? Should we be holding off? And so those are some of the questions that we're going to try and answer today. So just off the top, we believe we're in a structural bull market in stocks since 2013. And, as has been the case since 2013, we've stayed above that rising 200-week moving average. You can see we finally made a new high in January after going through 25 months, December of 21 through January 24, without making a new high. That was a typical cyclical bear market. We made the low in October of 22. And through that piece, we said, look, at some point we make a new high, and that probably kicks off 18 to 24 months, possibly 36 months of pretty strong, consistent results. As we did coming out of the lows back here in 2018, as we did coming out of the lows in 2015, many of these cyclical bear markets going back over the last number of years. And that is what appears to be happening in the index. The S&P 500 up 3.9% so far in the month of June. That's after a pretty strong month in the month of May and a weak month in the month of April. So we don't go straight higher. So if we look at the index itself, we had this wobble here in the beginning of April. Market pulled back a little over 5%. Indicators turned back higher again, and the market marched up. But we have been seeing some deterioration in some of the breadth. And you can see it most obviously when you look at the equally weighted S&P 500. The RSP, equally weighted S&P, hasn't made a new high since the beginning of April. That was April the 6th. And you can see that it's been trading in a narrowing range. So the first thing I'd say is, look, the equal weight S&P made a new high for the first time since 2022 in April of this year. That's great. It means that it took longer for the average stock to make a new high. We've been really consolidating since then. We're not breaking down. We're still putting in a series of higher lows, but it's something that we want to watch. When we look at the percentage of stocks that have been outperforming the index, this past 2 years has been a very narrow market. There have been certain stocks, which fortunately we own, that have provided lots of returns. It's not dissimilar to what happened in the late 1990s, which is why we've been really critical of portfolios to try and make sure that we're only in things that continue to work. And we'll see what happens. But if you're in those small number of stocks, that's good. We want to watch to see if there are sector themes gaining or losing. Now, when we look outside the US, we've highlighted that after many years of underperformance, a lot of global markets have acted a little bit better. These are monthly bars. So Japan certainly has had a great move higher and garnering interest from people like Warren Buffett. We've been there now for about 18 months with a position in our global portfolio and our macro portfolios, wanting to take advantage. India is trading at new highs after many years of making no net gains. It's been one of the very strongest performing markets year to date. Taiwan, heavily dominated by semiconductors, and Taiwan semi, which of course, has its geopolitical risks, has been marching its way higher after a multi-year period. This was 2001, the beginning of the range. Euro Stoxx 50, after making 5 straight monthly gains, has chopped sideways now for 3 months, but holding those gains very nicely. And the TSX has been consolidating over the last 4 months. And I put the TSX in the same group of global markets because the sector makeups of the TSX are very similar to what we see in the MSCI All World ex-US Index, which is that the biggest sectors are industrials, financials, energy, and materials. And that's big makeup of the TSX. So it shouldn't be a surprise that the TSX had many years of underperformance. A lot of people like to highlight the significant underperformance of the Canadian market over the last number of years, but on a relative basis, in general, behaving better over the last 2 years. When we get to fixed income, we've highlighted the generational low in interest rates as your 10-year yields that were falling from 1981 through 2020. And they certainly made a sharp reversal. If we look at just the period from 1982 through 2024, we can see a clear change in behavior. Rates are now working their way higher and higher highs and higher lows. And while it is encouraging that most recently we haven't made another higher high, I think if we break 5%, that would be seen as quite negative in the near term. Rates are maybe moderating a little bit. That's good. But the TLT, the long end of the US bond market, is now, 4 years into a losing downtrend. So you might be getting your coupon, but if the price of the bonds are falling, that's not a great thing. And we know that over the last 18 months, bonds continue basically to be flat. So our job is to try and identify where we should be focusing. Broadly speaking, we believe that stocks are a better place to be than bonds. And since the bottom in rates in 2020, compare the returns of the S&P 500 versus the aggregate bond index, which is made up of various issuers and maturities, it's been a pretty clear theme, even through the stock bear market in 2022. No real advantage to be in bonds. And we are clearly marking our way higher and have been doing so since the early part of 2023. So stocks are preferred asset class when we're comparing those two. When we look at income securities, we know that fixed income's been negative, but dividend growth relative to high dividend paying stocks, which act a lot like bonds, has been our preferred choice for income portfolios. And you can see if we compare the RDVY dividend growth ETF to the high dividend paying ETF, FTL, very clear outperformance with one significant break, and that was during the bear market 22, which reset things down to the moving averages, and we're moving our way higher. So dividend growers are our preferred vehicle for income investments in portfolios, mostly because a rising stream of income, of course, offsets a rising cost of living. And we think that will be attractive to a lot of investors, and likely we're to see money flow out of fixed income into dividend growth oriented stocks. We know the last time rates started to move higher from the late 1940s, the best performing securities on the planet were dividend growers. And this is where we're focusing in our income portfolio. The income mandate that we manage for clients, for those that don't know, is a very open mandate. It's a mandate to find securities that have an improving ability to pay us. So that might be bonds that have been issued by companies that have improving balance sheets, where we could get our coupon plus some improved value. It might be preferred shares. It could be high dividend payers. In this case, right now, we're focused on companies that have an improving ability to pay a higher dividend. And we think that we'll get the rising stream of income. We'll get some improved value in the capital value of the shares as people recognize these things are good, getting better. And it allows us to diversify away a lot of risk, especially at a time when bonds are in the longest bear market basically on record. The length of the drawdown in the bond market really is unrivaled. This is very different than anything we saw since the early 1980s. And so we have to treat it differently. If I look at how things have kind of gone since the middle of March in 23, when we started to see the market broaden out, the aggregate bond index is up 5.2%, sorry, 2.5% over that last 460 days. The high dividend paying cohort of securities up about 16, our income portfolio up about 28%. So clearly money is flowing into this area, and we're making this a core in all of our portfolios from a risk reward standpoint. We think that dividend growth has great characteristics. Moving on, commodities. Commodities, after a very long bear market at its first leg higher, starting when rates started to move higher, we moved into a more inflationary world. We've been to a period where the Fed was tightening. And you can see in the last 4 months, even though it's not a straight line higher, commodities index is working its way higher. Now, not everything moves at the same time. There's energy in here. We've got agricultural commodities. We've got metals in this basket. But broadly speaking, we think we've just started the second leg higher for commodity prices. And lots of people might like to argue that, people concerned about, what if manufacturing slows down? What if some of the geopolitical problems start to get solved? Neither of those seem that likely right now. What I would say is that commodities relative to fixed income is clearly outperforming. And we think there are times when you have to hedge a portfolio for the risk of falling prices or disinflation. And there's also a time when you probably should be hedging a portfolio for rising prices or inflation. And commodities clearly are winning the day here over the hedge of bonds. We'd rather be hedging with commodities to hedge our inflation risk. Even commodities relative to the equally weighted S&P 500, had one leg higher and arguably consolidated. It looks as though it's starting another leg higher. So something certainly to think about. Now, one of the big contributors in the commodities world is energy prices. This is a point and figure price chart of the price of crude oil. And we know that since April, crude pulled back from $87 a barrel to a low of 72. Important to recognize that. These pullbacks can hurt. But what I would point out, something that I'm watching, is that today, crude traded to $81, breaking a triple top, breaking crude out to the upside. And I think that's really important. We know that some of the stockpiles are coming down, heading into summer. And we know that speculators have had exceedingly low bets on the futures contracts for both Brent and for WTI. So market's leaning one way, expecting a slowdown. Inventories are coming down, and we see crude prices waking up. When we look at natural gas, this is a longer term point figure chart for natural gas, 2022 through 2024. In February, natural gas hit $2.10. It had a sharp rally into resistance, pulled back, made a series of higher lows, most recently pulling back to yesterday to 275, today 290. Reverses back up into a column of X. It looks to me like we are reversing, a long and extended downtrend in natural gas prices, which I don't think the market is betting on. So two things I think are important to watch in the commodity space in the near term. And in the copper, yes, copper prices have pulled back. These are monthly bars. We did pull back from the highs. We hit $5. I don't think this is a big deal. We are extended away from the moving averages. It can certainly pull in a little bit. It looks as though some of the oscillators are turning back positive. We'll see. When we look at gold, gold did pull back a little bit. Again, these are monthly bars. This was the last bull market we saw in gold that started in 2005, you had a whole bunch of months higher off the bat before you consolidated. We've only really just started this process coming out of this bear market and consolidation. My guess is probably prices are much more tilted to the upside than the downside. These are contributors to the commodity complex. So those are the major asset classes. We'll talk a little about where we're focused. If we look at how things are going on over the course of the year, equally weighted S&P is up 4.9%, a long way from the market cap weighted. TSX is up 4.5%. The aggregate bond index up to down 20 basis points. Really pleased. Our equity portfolio is up 15%. Our income portfolio is up 14.7%. Our new global portfolio up 7.6%. And things definitely going in the right direction. Okay, so we don't have to be everywhere. When we're in a market that's narrow, we really have to pick our spots. And we really have to be tactical about how we manage portfolios. And we'll talk a little bit about that. Our job, I think, that we're given by all of our clients is use the tools that we have to try to identify the productive assets to focus in. We shouldn't be living by some static 60% stocks, 40% bonds, and even though bonds are losing money for 4 years, stay in them. We don't agree with that. We think our job is to find productive assets. People can go out and build a portfolio of ETFs and have little bonds, little stocks, and commodities, and that's an approach. We think we want to be more targeted. And leadership could be specific sectors or themes or geographic regions. We're always watching for change to see whether we see deterioration in areas that we're focused in or new areas of leadership to poke their heads up, which would give us opportunity to diversify. And we're always willing to play defense. Okay, so we're really trying to take a tactical approach to this. We think that 70% of return comes at the hands of being in the right neighborhoods, so the right asset classes and sectors within those asset classes. And then our investment team has a job to drill down and identify specific securities in our bottom-up work that we can use to express those views. Finding securities where we can see fundamentally things are improving, that technically are behaving the right way, and we build a portfolio in order to try and take advantage of that leadership. Now, that's a living, breathing thing. Not everything's going to work out. We know that probably our most important job is having a very clear process for carving out the things that don't work before they hurt us. Now, we decide where to focus using these breadth models. And in simple terms, when a sector becomes out of favor and unloved, generally a strong stock or two will turn up early. And then as things improve, buying will spread to more and more securities. When breadth is expanding, it's healthy. It means money's getting put to work. Now, it also, though, means that when a sector's been doing really well and the leaders are carrying on to make new highs, if the weaklings are starting to fall away, it tells us there isn't enough new money getting put to work, but there's enough money leaving where the risk-reward levels have changed. So what does it mean? When breadth starts to contract, it doesn't mean we're going to go sell all our positions. Our positions might sail through. It may be that we do have the best securities in the groups. But to the extent we see stocks break down in price, we got to make an exit. If a sector or a theme or an asset class is seeing deteriorating breadth, that means we don't add new money. We sit on our hands. And if a cash position builds, we wind up pretty well defended if things get worse. So I raise this specifically because we highlighted a few weeks ago that inside the makeup of the market, early in the year, 92% of stocks were trading above their 50-day moving averages. So short-term measure of trend. In March, 85% of stocks were trading above their 50-day moving averages. In April, 50% trading above their 50-day moving averages. And that's a sign that the market is narrowing. Last week, when we put up our breadth measures, we highlighted that the short-term measures, percent of stocks above the 50-day, had been weakening globally for the US and for Canada. Percent of stocks with weekly price momentum or upward trajectory had been narrowing. percent of stocks making new highs versus new lows narrowing, and the percent of stocks trading above their 150-day moving average was rated around 50%. So if I click to today, you'll see things got a little narrower. We went from 53% of stocks in the NYSE and uptrends to 47%. We saw these short-term indicators coming down further. So that makes us ask the obvious question, where is the deterioration taking place? Are there new areas of strength that give us some information? I thought this was a very interesting picture looking at returns over time based on changes in breadth. So on the 14th of June, we got to a point where over the previous 4 weeks, 1,100 issues were lower on a net basis in the market, yet returns were positive. That means a small number of stocks is having a big impact. Now, we have fairly concentrated portfolios, 20 to 30 names maximum. We don't have 100 or 150. And we're very focused in those names, so it means we watch that basket very carefully. And so we'll touch on that. So let's talk leadership for a minute. Technology. Well, after a number of months where on a relative basis, technology as a sector, Liz's large cap tech ETF XLK was flat to down, even though there were some strong stocks in the basket, we've seen a nice move higher over the last 2 weeks. Now we look at the biggest companies in the XLK, Microsoft, Apple, Nvidia, Broadcom. These are some of the strongest stocks. And so we notice that we get a nice pickup in relative strength, and that's important. We're there. We talked over the last 2 weeks in both cases about dividend paying or dividend growth oriented technology companies having made an inflection higher in relative strength, and that this was a focus for us. In our macro portfolio, we have an 8% weight in the TDIV ETF. Nvidia, which is in their top 3 positions in the firm, has continued to march its way higher, and that's on the news every night, trading better than 99% of companies in the S&P over the last 52 weeks. We know that this just recently split 10 for 1 and continues to march along. Their dominance in the GPU market at this point really is unrivaled. Combination of their software design, their platform that they built, and of course the chips that they're selling. Broadcom had a remarkable week this week. So I had some questions about Broadcom this week. The way we look at this, Broadcom made an excellent acquisition in VMware that gave them a very strong software platform for companies to use to design their own chips. So of course, Broadcom produces chips, but they give their clients the capability to design their own custom chips, people like Amazon and Meta using these tools. So they're a very strong competitor to NVIDIA in a different way. Not everybody wants to be on NVIDIA chips. So we think that they are a strong second in the semiconductor race for AI. And the market appears to agree, now trading better than 98% of companies in the S&P. Microsoft continues to chug along, making new highs. And our newest position in tech over the last while was Qualcomm. And I haven't spent any time talking about Qualcomm, but Qualcomm is known for making mobile phone semiconductors. They go into Apple phones, they go into others, they go into Huawei phones, they go into Xiaomi phones. So there is some risk with their business in China. However, they also are the ones who have designed Microsoft's new chip that they will use with the Microsoft Surface and their AI PCs that they're building. And we think that the upside in the relationship with Microsoft, who think they can get 20% market share over the next year in AI-driven laptops, is offsetting the risk that we see in sanctions on Chinese cell phones. So again, it's having a great run. So these things are big contributors to portfolios. But I will say that the unprofitable tech or the highly innovative companies with no earnings, this is the ARC ETF, shows no sign of improvement, and relative strength and price continues to be very weak. So we have to be very targeted, I think, in tech. Financials have been a very big sector for us. This is the long-term picture of the XLF ETF. It broke out in 2021, consolidated through the Fed's tightening cycle over the last number of months, has started to march its way higher. As we've mentioned, we think we're in a new bull market for financials. Certainly, you can see this month they've pulled back very slightly some of last month's gains. Our big holdings, JP Morgan continues to be very attractive. Certainly nothing broken here, making higher highs and higher lows, better than 85% of companies in the S&P. Goldman Sachs, after pulling back into the moving averages, which is obviously quite typical, had 3 great days, last 3 days, trading better than 90% of companies in the S&P. 2 canaries in the coal mine for capital markets. I would say these are not telling us that there's a problem, even though we're seeing narrowing breadth. In the property and casualty area, progressives continue to act well. Fairfax, which is the largest holding we have in the firm, made a new relative strength high today. So performing really well. And some of our life insurance exposure, Manulife, made a new relative strength high today as well. So financials, tightly tied to capital markets, are not showing any kind of significant deterioration. So that gives us some comfort. One position that we did lose over the last 2 weeks is National Bank. Many may know National Bank bid for Canada Western Bank. They bid a premium well above book value, which I think we saw as being excessive. And if you use stops, you use stops. And we got stopped out of the position. We have lots of financials exposure. We don't have to have this one. You can see a significant drop in relative price performance. Allstate is the other position that we've taken off in the financial sector. Again, a stop is a stop. We don't have to own everything. We only need 20 to 30 names, and we want to make sure that the ones we own perform well. So as a result, we wind up across the firm at the end of this week with just a little over 5% cash in portfolios. Our industrials holdings, pulled back into the moving averages over the last few weeks, turning higher here this week. We talked a little bit about the fact that cyclically we got to pretty extreme lows in inventories and we were likely to see a pickup. The secular theme of capital spending, both in the US and Japan on factory construction, the defense sector, clean energy, and spending on industrial metals and mining, I think is going to drive returns here in this sector for quite some time. The aerospace and defense sector pulled back into the moving averages and then turned higher. The small cap industrial companies, again, pulled back into the 50-day moving average and has turned higher, trading better than 88%. Relative strength trend is in place. We feel comfortable here. Eaton Corp's one of our biggest holdings. Probably the biggest holding in industrials. They sell electrical equipment into the utility industry. No sign that anything's going wrong here. Materials have been putting in a series of higher lows and higher highs. Copper, after running 54%, the copper ETF from the beginning of the last rally pulled back about a third of what it rallied 54%. We pulled right back into the moving averages, looking as though things are turning higher here. Cameco in the uranium space, up 41% in the most recent rally, again, pulling back into rising moving averages. Energy, after having a great rally, pulling back into the moving averages. And as I mentioned, we're looking at these as very long-term positions. CNQ, 5% dividend with 20% dividend growth. They are not going to go straight higher. But certainly the dynamics continue to be very good. Same for Imperial Oil. Again, just pulling back into moving averages. No real concerns here. So nothing much changing on the sector front. Now, if we thought that maybe Fed policy was too tight and that recent weaker economic data meant that we were headed for some kind of difficulty, there's a few things we'd watch for. Well, the first thing we'd watch for is a sign that defensive sectors that are not economically sensitive, but that are highly sensitive to interest rates, would start to outperform. you can see telecom is one of those groups, and it has not done anything to show us outperformance. Consumer staples, well, no real performance here. Consumer discretionary has been squeezed by higher rates, and we've seen poor performance in the market by companies like Starbucks and Nike, McDonald's, certainly weaker. But there have been stocks that have been strong. Of course, Amazon's been great. Costco this week ramped higher again to a new relative and an absolute high. Dollarama's performing well. Loblaws performing well. So you got to pick your spots. We're not adding anything to the sector, but we're certainly holding the things that we have. Healthcare, another defensive sector you would have expected to see pick up if we thought there was concerns about the economy, and we're really not seeing any relative pickup there. But again, selectively, the leaders continue to lead, right? Lilly is our biggest healthcare position by a wide margin, continues to take advantage of the weight loss drug opportunity. And McKesson, which would be our second biggest position, had a very good last 2 weeks in hospital supply and equipment. So the sector picture isn't really changing very much. A week ago, we highlighted that the weakest sectors, if we take all the sectors and put them on a bell curve based on the percentage of stocks performing well, the ones on the furthest left are the sectors that have the smallest number of stocks performing well. A lot of it had to do with consumer, healthcare. We look at it today. We moved a little further to the left overall. Last week, the average sector at 42% of stocks and uptrends. The average sector has 40% this week. The list in the left-hand side is a little bigger, but it includes telecom, healthcare, a lot of consumer, leisure, auto, biotech, gaming, housing, retail. These are sectors really we have been avoiding. And on the other side, industrials, financials, Wall Street, that's things like JP Morgan and Goldman Sachs, precious metals, semiconductors, computers, oil service. So no real major change here. So the market is selective, and we are selective. Our sector weights are more or less the same. We have come down, a little bit in industrials. We came down a little bit in communication services. We're not adding anything really in real estate, consumer discretionary. We added some utilities about 4 weeks ago, but not a lot changing. So market continues to be selective. We look for a time when we start to see an additional broadening. We are holding back on adding new positions. For clients who have come in, we start with a staged approach. So we had some money come in for one client this week. We put 1/6 of the money to work, and we'll step it in over a period of several weeks. Or if breadth models turn higher, we'll step it in higher. Signs of risk: no real expansion in the credit spreads that are being demanded by bond investors. So people seem to be comfortable in credit, and volatility continues to be quite low. So we just highlight, in years where the market started out really strong, it generally continues to be strong through the rest of the year, but we'll watch for signs of change. So it's feeling a little like summer. Market's a little quieter. We know there's a holiday in the middle of the week this week for U.S. friends. We'll see whether there's much change taking place. My sense is some of the stuff that's pulled back over the last 4 weeks seems to be finding a footing, but we'll wait and see. If things get tougher, we'll get more defensive. And with that, Pamela, if there's any questions, certainly happy to answer.
Thanks so much, Dave. Yes, we have a few questions here. The first question comes from Steve, and he wants to know, David, Canadian stock markets have been somewhat of a dog since 2015. Steve's words, not mine. Do you expect a better outcome if we have a change in Ottawa in the coming years? Current politics are not good to attract money. What are your thoughts?
Yeah, well, you know, it's interesting. I really think that the most important thing for the Canadian market is the sector makeup of the market. And from 2015 until 2023, a bunch of the key sectors have been sectors that you didn't want to have too much exposure to. So that plays a part. Certainly politics do play a part. You know, there is a view that people don't want to be putting money at risk in a market where regulations seem to change without much warning. That's I think a concern. I think in the very near term, we've seen stocks like Imperial Oil and Dollarama and others see a little bit of selling pressure based on the change in the inclusion rate in the capital gains, but that should be over pretty quickly. But there are a few companies where families have big gains built up that are certainly, you know, having an impact. I think a change in government in Canada would be seen as very positive. But we may not have to wait for that for our market to do better. If we're right on our sector themes, you know, energy should perform. There's, I think, a big discount already built into Canadian energy companies that's been driven by, you know, the policies of the Liberal government. Certainly that discount could start coming off, and probably should, because it's pretty clear as it stands right now that the Liberal government is not getting reelected unless they change their leader and really change their spots. So a change would help, but I'm not going to wait for that time to be invested. I think that we see pretty positive signs for those key sectors already.
Thanks so much, David. The next question comes from Eric. He says, David, I realize you don't sell winners until they stop working. How do you handle when a new client experiences a 45% increase in NVIDIA over a 6-week period, when this is unlikely sustainable and these incredible returns year to date?
You know, this is a tough one. It's a tough one for a couple of reasons, and we spent lots of time talking about this internally. You know, we did trim NVIDIA once over the course of this past year because the position size got big. I think we're all learning, you know, how big is the opportunity for artificial intelligence? I don't think anybody knows the answer to that. But we do know that the biggest beneficiary right now is NVIDIA. And we cannot, with all of the work that we've done on it, find someone who is ready to eat their lunch. You know, AMD is nowhere close. And really, they've built an infrastructure. So sometimes your best stock can do way better than you thought for way longer than you thought. And we're not in the business of trying to sell NVIDIA now and say, well, I'm just going to find another one, you know, is not very reasonable. It could be that NVIDIA can just continue to chug along. So look, it's one position out of 20 or 30 in a portfolio. Let's say it's I don't know, 4% weight right now. If it started to fade on a relative basis versus the market, we can certainly trim the position and we will not get out at the high. But we do think that the market opportunity that we're seeing right now and their lead in that market makes it a company we really need to own.
Dave, thank you. The next question comes from Larry. It's similar to the last question, so I'll preface it by saying, David, am I wrong? But it seems you are not overly concerned about how technically overextended semis are and how crowded the trade is currently. The fundamental picture seems undeniably positive. Is the best strategy now just to hold longer term rather than fear a correction?
Yeah, look, there are going to be corrections, but the thing that I've learned is that a company that's the undisputed leader in an important sector can lead for a long time. And pullbacks in general will be shallow because there's people waiting under the surface to buy the stock because they don't own it. undeniably, at some point, it will get too far out in front of itself and it'll pull back. But from a risk reward perspective, nobody's portfolio is dominated by it. It's one holding. And as James Callahan would point out, it's probably cheaper right now based on next year's earnings than it was a year ago, because people have underestimated the market opportunity every quarter so far. So we'll see. But I've always said, if we buy 20 companies and we're trying to buy things that are good, getting better, the reality is 2 or 3 will work out way better than we ever expected. 7 or 8 will be pretty good, a bunch won't work. Our success is tied to our ability to hold the winning position so long as they continue to work. And, yes, things get extended, but then they can get more extended. And I don't think there's many people who would disagree that the opportunity posed by artificial intelligence across all kinds of industries that some people haven't even considered is one that you really want to make sure you're going to participate in. So it's a tough one.
Thanks, David. The next question comes from Robert, pivoting from semiconductors to the Canadian banking sector. Robert wants to know if it would be possible for you to give your take on the Canadian banking sector, especially given the way the Canadian banks have been trading as of late.
Yeah, sure. I mean, the Canadian banking sector is tricky because it's not homogenous. Let's just see if I can jump on here and give you some examples. When we look at it, you've got Scotia, and Scotia has been a clear underperformer. It's highly dependent on Latin America, Caribbean, South America, which has been difficult for them. They're going through changeover in CEO, and they've obviously got lots of work going on to see what they can do to improve the situation. They did not raise their dividend recently, so it's a position that we've just sort of avoided. Commerce. Commerce has been a decent performer. Let's go to a shorter term picture. It's in higher lows and higher highs. We're sort of at support. Canadian banks have pulled back. It's more focused on Canada. There's some concerns around the housing market in Canada. So, the stock's kind of flagging. If you look at Royal, it's a different picture. It's been a strong outperformer. It has also pulled back into support. But they're winning in wealth management and they're winning in capital markets. It's, I think, the 8th largest global bank today. And if you're going to own one bank in Canada, probably that's the one. Bank of Montreal has had some difficulties in their US operations, and it's one that we've avoided. Of course, TD, we don't have to talk too much about the difficulties they've been going through, but that's one that doesn't certainly qualify for us. You really have to pick your spots. When I've been asked for the last 2 years, what's our favorite bank? It's been JP Morgan. They are the best of the best. Over the last few months, we built a position in Goldman Sachs because we really like capital markets. And we think that the opportunity that is coming for mergers and acquisitions and initial public offerings and trading revenues and wealth management is going very well for Goldman Sachs. So it's very much about picking your spots. If you look at the large banks, ETF in the US, KBE, it's pulled back to a higher low. If you compare that to KRE, which is the regional banks, that's been a real relative underperformer because they've got a lot of exposure to the commercial real estate market in the US. So even though we call them all banks, they're all different. Even in Canada, when there's only 5 of them, they're all different. And you really have to pick your spots, I think. And remember, when we're talking about financials, we're not just talking about banks. We're talking about talking about insurance. That's the insurance ETF, KIE. It's been outperforming banks. If we look at some of the financial technology companies, like the TMX group, again, very, very different dependent on capital markets. It would be unlikely if we thought the Canadian market was going to go in the tank that TMX would be trading within a whisper of new highs. And I think, technically speaking, this is one of the best financial stocks you could buy in Canada. So you have to pick your spots.
Thanks so much, David. And the final question is on copper. This viewer would like to know when you would add new money to a copper position.
Yeah, I think we're getting there. I showed earlier the COPX, which is the copper producers ETF. It's pulled right back into the moving average. If I look at something like a Tech B, it's pulled right back into moving averages. We should see them hold in and around these levels. And I think a big part of it has been the 10-year yield ran back up higher, the US dollar ran back up higher. I think we had two inflation numbers, a CPI and PPI number come in slightly lower, which ultimately is good. You saw a couple of economic data points that were a little bit weaker. The most recent employment data came a little weaker. I would say in the last month, there has been more concern, and so more people trying to express a more bearish bet on the economy by shorting some of the commodities, shorting some of the commodity producers. I think they're mistaken, and I haven't seen them break down in any way. I would be awfully careful being short these things. So I think that we're getting darn close in and around these levels. But again, as I mentioned, we're not adding new things currently because, we've seen some narrowing breadth. I would prefer to buy them higher, to add to them higher when we start to see some expansion of breadth again.
Thanks so much, David. That concludes the questions we've received today. So on that note, I'll leave you with the final word as always.
Well, I want to thank everybody for tuning in. I get to hang up the call today and jump in the car and drive to go see my youngest daughter's convocation tomorrow. So I will not be in the office tomorrow, Pam, but I'll keep an eye on things. It's kind of exciting to think that it's possible. I've written my last tuition check, and I hope everybody is enjoying their summer. We'll look forward to seeing you again next week. And if you got questions in between, please reach out. We've had some great conversation with folks over the last little while, and certainly it's a nice time of year. People have a little bit more time on their hands. We certainly are happy to have conversations where we could be useful. So thanks for tuning in. We'll see you again soon.
Congrats, Dave. We'll talk to you soon. Bye.